Hello, and thank you for attending our presentation this afternoon, a CPA's 2026 Guide to Household Payroll and Tax Compliance. My name is Trevor Sparks with GTM Payroll. We appreciate the time you're able to spend with us today. A couple of housekeeping notes before we get started. If you have any questions, please use the questions functionality in the presentation console to submit them. We'll answer as many questions as we can during the presentation. If we don't get to your question, we'll follow up with you within the next day, and you'll receive an email after the presentation with a link to download the slides and a video recording. During today's presentation, we'll ask you 4 questions. You must answer at least 3 questions to receive CPE credit. As a reminder, this course is 1 CPE credit hour. If you successfully complete the course, we'll email you a certificate of completion within 5 business days. Here's an overview of what we'll go over today. We'll discuss the basics of when someone is the employer, what happens as an employer, what obligations the employee has, what risks the employer has, what insurance is required, what's been happening with household employment and what's new this year, including paid leave laws, rising minimum wage rates, and labor compliance regulations, and how to convey the importance of compliance to your clients when saying it's the law isn't enough. At the end of this presentation, you'll understand your client's household employment tax responsibilities and how to manage them, new labor laws that are impacting household employment, what's new this year in household employment tax compliance, and how to explain the benefits of compliance to your clients, as well as the costly downside if they're caught not following the law. So at this point, I'd like to turn it over to our presenter today, Mike Truicolo. Mike.
All right, thank you, Trevor. So before we get into what's new, I just want to take a step back and look at the basics of household employment, starting with who is a household employer and who are domestic employees. For the most part, this is going to be a family that's hiring a nanny to look after their children in the family's home. However, we are also seeing more and more senior caregivers hired to help elderly loved ones age in place, as well as nanny shares, where one nanny cares for the children of multiple families in one of the family's homes. They've grown in popularity as an alternative to daycare centers. We've come a long way since 1993, when President Clinton's nominee for Attorney General, Zoe Baird, was removed from consideration for the job because she and her husband had broke the law by employing 2 illegal aliens to nanny and chauffeur their child and failed to pay employment taxes. That prompted Congress to change the way household employment taxes are filed and to create the Schedule H, which shifted nanny taxes onto Form 1040. So we typically think of a household employee as a nanny, but anybody who works in someone else's home can be considered an employee. So as we mentioned, senior care is a growing workforce. If your client privately hires a senior caregiver, either for themselves or for an elderly loved one, such as a parent, instead of going through a home health care agency, that worker can be considered an employee of the senior or their family. Another area you may not think of is seasonal or temporary childcare. A babysitter with regular hours, a nanny hired just for the summer, or an after-school nanny can easily earn enough for household employment taxes to kick in. Other household employees can include personal assistants, housekeepers, chefs, chauffeurs, and any other estate staff, as well as nanny shares. When a family hires a nanny, it's straightforward who the employer is. But I just want to point out that there are a couple of additional wrinkles when hiring senior care. Your clients have a few options for finding senior care. How they bring the in-home caregiver on board will determine whether they are now the employers. A home health care agency will employ the caregiver to work in the senior's home, pay the employee, file taxes, and comply with the tax, wage, and labor laws. So in this scenario, the agency controls the employee's job duties. The agency will select the caregiver and send them to the senior's home. However, the senior may not always get that same caregiver. The agency in this case is the caregiver's employer, so they control the employment. A referral or a placement agency that recruits the senior care worker on behalf of the family and charges a fee for this service will then hand over control of employment to the family, who is then responsible for the payroll, taxes, insurance, and compliance. So in this scenario, the caregiver is an employee of the senior or the family, and this is similar to a family that's hiring a nanny through a nanny agency. By doing it themselves, a family finds, recruits, and hires a senior care worker without assistance from an agency. The family will also handle payroll, taxes, insurance, and compliance. So in this scenario as well, the caregiver is an employee of the senior or their family. A family may try to avoid household employment taxes by classifying their worker as an independent contractor. That way, they can give them a 1099 at the end of the year, and the employee pays their entire tax obligation. An independent contractor pays both the employer and employee FICA tax obligations, which is about 15.3% of cash wages. And in this case, the family also avoids unemployment taxes and other responsibilities, such as workers' compensation insurance. However, the IRS almost always classifies household workers as employees rather than independent contractors. So that's not going to work, and here's why. So it comes down to a matter of control. A family sets their employee schedule, tells them how to do their job, and the employee uses the family's tools and equipment. For example, a family with a nanny says your work hours are Monday through Friday, 8 a.m. to 6 p.m. The baby naps at this time and is fed at these times. The nanny uses the family stroller for walks and their kitchen to prepare food. A nanny is not going to determine when they'll work, and they're not going to make up a baby's sleeping schedule and eating schedule. The family controls the employment, and the nanny is their employee. And if there's ever any doubt with this, you can file Form SS8 with the IRS and have them determine the worker status. Just understand that employee misclassification, is considered felony tax evasion. Trevor, I will turn it to you for our first poll question.
All right, thanks very much, Mike. Our first poll question should be on everyone's screen, and you can answer right there, A, B, C, or D. Which of the following affects whether a domestic worker is classified as an employee or an independent contractor? So as a reminder, these are the poll questions we'll ask throughout the presentation. If you answer 3 of the 4 poll questions, you'll be eligible for CPE credit. If you have any questions as we go through our material here today, any questions, just submit those in the question box in the webinar console, and we'll get to as many questions as we can by the end of the presentation. And if we don't get to your question, we'll certainly follow up with you in the next day. And you'll also receive an email later today with a link to download this presentation as a PDF, as well as a video recording of the presentation. So you have those resources as well. Okay, looks like we have, looks like everybody is in on this one. And the answer here is D. All of the above affects whether a domestic worker is classified as an employee or an independent contractor. All right, Mike, turning it back to you.
All right. So one of the first steps in understanding nanny taxes is determining whether the employee's wages meet or exceed the employment coverage threshold for domestic workers. This is commonly referred to as the nanny tax threshold. There's no coverage threshold for most industries, so every dollar of wages is covered and taxable. Household employment is one of the industries with an employment coverage threshold. The Social Security Administration sets this amount each year, and for household employees, it adjusts with the National Average Wage Index. This year's threshold is $3,000, and you're going to use this threshold when you're filing a client's tax return during the next tax season. So you can see how easy it can be for a temporary or seasonal worker, such as a summer or after-school nanny, to exceed that threshold and trigger nanny tax compliance. If a family goes over that wage threshold, they'll need to withhold and pay Social Security and Medicare taxes, which are commonly called FICA taxes. Those FICA taxes are 15.3% of cash wages, which is split evenly between the employer and the employee, with each contributing about 7.65%. Employers can choose to pay their employee share and not withhold it. Keep in mind that the taxes paid to cover an employee's share of FICA must be included in their wages for income tax purposes. They aren't counted as Social Security and Medicare wages or as federal unemployment wages. You can report the Social Security and Medicare taxes paid in boxes 4 and 6 of the employee's W-2 form and add the taxes to the employee's wages reported in box 1 of the W-2. Just as a reminder, make sure you don't count any wages that are paid to a spouse, a child under the age of 21, a parent, or any employee under the age of 18. For unemployment taxes, if cash wages to an employee is $1,000 or more in any calendar quarter, then the employer pays federal unemployment tax. That's 6% of cash wages on the first $7,000 of wages. An employer may also owe state unemployment taxes. They may be able to take a credit against their federal unemployment tax if they pay state unemployment. It could be as much as 5.4%, which will really reduce the amount owed for federal unemployment. And for unemployment taxes, the exclusions are spouses, children under the age of 21, and parents. So just to review a couple of key points. Household employment tax responsibilities kick in when the $3,000 threshold for 2026 wages are met. The family pays 7.65% of their employees' pay in FICA taxes, and the family will also pay federal and state unemployment taxes if applicable. For the employee, they also owe 7.65% of their pay. This is required to be withheld and remitted by the family. Again, the family can choose to pay this on their employee's behalf instead, but either way, the employer is responsible for remitting the employee's portion of FICA taxes. Federal income tax does not need to be withheld, only if the family wants to. However, it's always a good idea to withhold that so that your employee is not stuck with their entire income tax bill at the end of the year. If a family does decide to withhold income tax, they'll need to provide their employee with a W-4 form and a state withholding form. These forms will determine how much to withhold from the employee's pay for income taxes. State and local taxes, if applicable, will obviously vary depending on where the employee lives. So we know what is owed, but how are these taxes remitted? So there's two ways that you can go about this. The first way, and probably the best way to do it, is to remit household employment taxes quarterly using Form 1040-ES, then detail the annual amounts paid on the Schedule H. If your client prefers, they could increase withholdings from their own pay to anticipate this increase to cover their household employment taxes. You should do one or the other. If their nanny tax obligation is large enough, your client may wind up owing taxes when they file and possibly be subjected to an estimated tax penalty and interest for underpaying taxes during the year. And Trevor, I will turn it to you for our second poll question.
Okay, thanks very much, Mike. Our second poll question should be on everyone's screen. An employer can choose to pay the employee Social Security and Medicare tax responsibility. This is a true-false question, so just answer A or B on your screen right there. This is our second of 4 poll questions. If you answer 3 of these poll questions, you'll be eligible for CPE credit. Any other questions about the topics we're covering today can be submitted in the question box in the webinar console, and we'll get to as many questions as we can today. If not, we'll be sure to follow up with you in the next day or so. You'll also see a brief evaluation survey pop up at the end of the presentation today. So if you just take a quick moment to answer just a couple of questions about the presentation today, it'll also be in an email you'll receive later today. There'll be a link there. If you can just take a moment and complete that. That email will also have a link to download this presentation as a PDF, as well as a link to a video recording of the presentation. So you'll have plenty of those resources for you as you manage your client's household employment payroll and taxes. Okay, looks like we have, yep, everybody is in on this one. The answer is true. All right. And Mike, I'll turn it back to you.
All right, so let's talk paperwork. So here are some of the forms that are needed as a household employer. The SS4 to apply for an EIN, which can be done online as well. The family will also need to be set up as an employer with their state and file a new hire report. And they'll also need to obtain a Form I-9 from their employee, and we'll get into that more in a moment. If they decide to withhold income taxes, they'll need to obtain a W-4 and a state withholding form from their employees. So a little bit about the I-9. Families with household help must collect an I-9 form from their employees at the start of their employment. This is something that we've all filled out when we've started a new job, and it's no different for nannies, housekeepers, or senior caregivers. As a reminder, the I-9 confirms a worker's identity and authorization to work in the U.S. They can submit a document from List A to prove their identity and employment authorization, or documents from List B and List C. Form I-9 must be signed no later than the first day of employment, and the documents must be presented within 3 business days from the start of employment. A family must inspect the documents, make copies, and return the originals to their employee. The documents must reasonably appear to be genuine and relate to the employee. Copies of the documents are kept in the employee's personnel file with the I-9, and they are not returned to any government agency. Employers must retain the I-9 form for either 3 years after the date of hire or for 1 year after employment is terminated, whichever date is later. The I-9 form can be completed electronically to help reduce errors, and it's available on the U.S. Citizenship and Immigration Services website at uscis.gov. At year end, the employee needs to receive their W-2 by January 31st. Since that will fall on a Sunday next year, they'll actually be due on Monday, February 1st. Also, Form W-3 and Copy A of Form W-2 must be submitted to the Social Security Administration by that same date. And then Schedule H will be filed with the employer's personal tax return. So what we've covered so far is basic tax withholding responsibilities. So now we'll get into some of the labor, tax, and payroll nuances surrounding household employment. Some of these are state specific, like a domestic workers' bill of rights. And there are also rules around overtime pay, live-in workers, sleep time, and companionship care. And in a growing trend, many states and cities have paid leave requirements now impacting household employers. So, what is a domestic workers' bill of rights? These laws bundle domestic worker protections, which could include minimum wage, overtime pay, paid time off, days of rest, and more. In New York, for example, household employers must give 1 day of rest every 7 days and provide written policies on sick leave, vacation, and work hours. They'll also need to provide 3 paid days off after a year of work, and they must pay on a weekly basis, and they'll need to provide a pay stub even if the employee is paid electronically or by direct deposit. Massachusetts is similar, and there are protections for mandated amount of rest time depending on hours worked, written work agreements, and more. If you have clients with household employees in any of these states or cities with domestic worker protections, you'll want to familiarize yourself with those obligations. The first Domestic Workers Bill of Rights took effect in New York in 2010. Since then, several other states and the cities of Chicago, Philadelphia, Seattle, and Washington, D.C. have enacted similar laws to grant basic labor protections to household employees. The latest state to pass domestic worker protection legislation was Washington, as we'll cover that law in more detail later in the presentation. You'll hear us say this frequently during the presentation, but noncompliance is costly. Here's just one example from New York. If your client violates the state's Domestic Workers Bill of Rights, which requires weekly pay for household employees, they can be sued for up to 300% of delayed wages, plus attorney fees and interest. So again, it's important to review the domestic worker protections in your state and city. The FLSA, which stands for the Fair Labor Standards Act, includes household employees. Domestic workers must be paid at least the applicable minimum wage rate. The federal minimum wage is $7.25 an hour, and that hasn't changed for quite some time. However, many states, counties, and cities have enacted higher minimum wage rates than the federal rate. In California, for example, minimum wage is $16.90 an hour, which supersedes the federal rate and becomes the applicable rate. However, dozens of cities in California have higher rates than the state rate. Los Angeles is now $17.87 an hour, and San Francisco is $18.67 an hour. So those local rates can apply. And just to make it even trickier, many states and cities have built-in increases to their minimum wage rates. Sticking with California, on July 1st, the Los Angeles minimum wage increases to $18.42, and San Francisco's increases to $19.61. You'll need to pay attention to this if your client is paying their employee minimum wage or close to it, as their hourly rate may quickly violate wage laws. So according to the FLSA, household employees are non-exempt workers, and that means they must be paid hourly rather than on a fixed salary. This also means household employees receive time and a half in overtime pay for hours worked over 40 in a 7-day work week. Live-in employees and caregivers who meet the definition of companionship care may be exempt from overtime, and we'll get into those situations more in a moment. California is a little bit different. Time and a half kicks in after 8 hours a day, 40 hours a week, and the first 8 hours worked on the 7th consecutive day of work in the work week. Your clients with household help should maintain records of hours worked and pay to ensure that they're meeting minimum wage and overtime rules. This is where many household employers can quickly get into trouble. They don't track their hours or pay, and they wind up getting sued by a disgruntled employee who seeks back wages because they weren't paid properly. Later on in this presentation, we'll also get into the new no tax on overtime. So live-in employees. You'll see this with nannies or seniors who need around-the-clock care. Up to 8 hours of sleep time can be unpaid if certain criteria are met, and 5 hours of continuous sleep is a big one. If a live-in nanny is expected to be on call during the night and their sleep time is interrupted to care for a child, even if it's just for a few minutes, and they don't get at least 5 hours of uninterrupted sleep, then the entire 8 hours of sleep time is now paid. The exception to this is California, which doesn't allow sleep time to go unpaid. As for overtime, federal law exempts live-in employees from overtime pay. However, some states like New York have their own overtime requirements for live-in employees, and those supersede federal law. In Minnesota, overtime for live-in employees starts at 48 hours, and Oregon, like New York, is 44 hours. In Hawaii and Maryland, live-in employees need to be paid overtime for hours over 40, so they're not excluded from OT laws in those states. So companionship care. This is a key consideration in senior care. If a caregiver falls under the companionship care exemption, then they do not need to be paid overtime for hours worked over 40 in a work week. If they don't have the exemption, then they must be paid the overtime. So the work is defined as the task necessary to care for an elderly patient. Bathing or dressing the patient, cleaning, and cooking are some of those activities. Only 20% of a caregiver's work time can be spent doing those sorts of activities to qualify for the exemption. That means the rest of their time is spent with fellowship and protection. Maybe they're watching TV, doing puzzles, playing cards, or doing whatever else is not necessary for the care of the elderly patient. It's also important to know that the exemption doesn't apply to caregivers that are hired through a third party. So, if a family thinks they can take advantage of the companionship care exemption, hiring privately rather than going through a third party could be a significant financial benefit. There is a growing trend for paid family and medical leave at the state level, and many of these programs include household employers. There are more than a dozen states with laws requiring paid leave. So we've listed several here and highlighted Minnesota as contributions to that state's paid family leave and medical leave program began in January. So employers are required to submit quarterly wage reports to the state for PFML purposes. We also highlighted Virginia, as its paid leave requirements were recently signed into law. We'll detail those later in the presentation. Localities like New York City, Chicago, Pittsburgh, and Washington, D.C. also have paid leave requirements. On January 1st, Pittsburgh's Paid Sick Days Act increased the number of paid leave hours available to household employees from 24 to 48 hours a year. Paid leave laws often apply to all employers, even those with just one employee, such as a family with a senior caregiver or a nanny. These programs may require a small employee contribution through a payroll deduction, or your client can cover that contribution for their employee. So it's important to review your state's paid leave laws and determine whether they apply to household employers. If they do, you'll need to follow the contribution rules if required. So we mentioned earlier that families may try to classify their employees as independent contractors to avoid tax obligations. Another way to avoid their responsibilities is to put the nanny or senior caregiver on a company payroll, and that won't work with the IRS either. This is considered an illegal tax deduction because all employees on a business payroll must directly contribute to a business's success. Of course, there is an exception. A sole proprietor of a business or farm with household employees can report their household payroll taxes on the company's Form 941 or Form 943 for farmers for ease of filing. However, that doesn't mean they can put their household worker on their business payroll. It just means that they can report the taxes on the Form 941 or Form 943. Even with this exception, for simplicity, it may be best to keep household payroll taxes separate from any business-related taxes. File Schedule H for household and Form 941 for business, or Form 943 if that business is a farm. Outside of that one exception, don't use the Form 941. Using the 941 and not a Schedule H is a common way that accountants may handle household payroll and make mistakes when reporting household employment taxes. This misstep can make more work for you, increase the risk of penalties, cause dual reporting to the IRS, and create other accounting issues. The Schedule H was created specifically for household employers to start reporting wages paid to employees during the year. It's an annual filing that's prepared with your client's personal income tax return. Form 941, however, is filed every quarter, even if your client didn't pay an employee during that period. And if you fail to file the Form 941, even if there was no payroll to report, your client will incur penalties. You should keep copies of the Schedule H and other employment tax forms filed, as well as Forms W-2, W-3, and W-4. For unemployment tax purposes, you should retain the total amount of employee compensation, the amount subject to unemployment tax, and state unemployment contributions. Make sure to keep payroll and tax records for at least 4 years after the due date of the return on which you reported the taxes, or the date that the taxes were paid, whichever one is later. Unemployment tax records should also be retained for 4 years after their due date or the date the unemployment tax was paid, and again, whichever date comes later. Most states have a 2-year statute of limitations on lawsuits filed by former employees, so keep documentation for at least that time period. And for auditing purposes, you may want to maintain tax and payroll records for up to 7 years. In any case, it's always a good idea to maintain employee, tax, and payroll records for longer than you think you'll need them. So those are the basics when it comes to tax, wage, and labor laws for household employment. I do also want to highlight liability insurance, as this can be one of the costliest mistakes a household employer can make, and an easy way for a family to get caught if they're not paying their employee on the books. You never know when an injury might occur, whether it's around the house, driving the kids in the car, or walking the dog. Unforeseen risks are always in play. Household employers in many states are required to carry workers' compensation insurance for employees who get hurt or sick on the job. This will help pay for a worker's medical expenses and lost wages. Without the required coverage, a family could face thousands of dollars in fines and penalties, and a possible lawsuit to recoup any lost wages and cover medical expenses. So even if workers' compensation is not required, it may be wise to get voluntary coverage. So who benefits from workers' compensation? Both the employee and employer are protected by this. Some of the employee's medical bills and lost wages will be covered, and employers are likely to avoid a lawsuit. This kind of protection can easily be worth tens of thousands of dollars for your high net worth clients. Popular question we get here at GTM when the topic of workers' compensation comes up is, doesn't my homeowner's insurance cover this? So the short answer to this is no. There's a difference between somebody visiting your home, slipping and falling, or even a worker like a plumber or an electrician getting injured while working in your home versus having somebody employed in your home for 20, 30, 40, or even 50 hours a week. You should never assume that an employee is covered under homeowners insurance. The exceptions for this are New Jersey and California. In New Jersey, you can add a rider for workers' compensation to your homeowner's policy, which is substantially cheaper than a standalone policy. In California, it's actually required to have workers' compensation on your homeowner's policy if you have a household employee. So this is what we mean by not having workers' comp is one of the costliest mistakes that a household employer can make. Fines can be as high as $5,000 for every 10 days of noncompliance, which equates to about $15,000 a month. It's not uncommon for fines to quickly reach tens of thousands of dollars. The GTM Insurance Agency, which is an affiliate of GTM Payroll, will receive calls when a family is looking for coverage because they were caught without a policy or their employee was injured. One time, a family came to us after getting a $120,000 fine for not having the required coverage in place. So again, looking at your workers' comp rules in your state is extremely important. And we've listed the states where it's required for full-time, part-time, and full-time only workers. So how does somebody get caught in these situations? So this happened in Connecticut to a family that was paying their nanny off the books. Their nanny fell down the stairs while carrying a baby, and the baby was okay, but the nanny injured her back. The nanny went to the hospital, and the doctor asked her how this happened. She responded, "Well, I was working." So it becomes a workers' compensation case now. The nanny missed several weeks of work. She expected her medical bills to be paid and to receive her typical pay while she recovered. The family didn't want to pay her because they were already paying another caregiver to cover for the injured nanny. So a couple things happen here. The family was exposed for paying their nanny illegally. And why? Because they didn't have workers' compensation. The family dealt with back taxes owed, plus fines and penalties on those back taxes. And they faced fines for not having workers' compensation. In Connecticut, that's $300 a day for every single day without coverage. So you can see how that adds up pretty quickly. On top of that, the family paid the employee's medical bills, lost wages, and a fill-in nanny, and now needed to find another employee as they had damaged the existing relationship with their nanny. And on that note, I will turn it to you, Trevor, for our third poll question.
Okay, thanks, Mike. Our third poll question should be on everyone's screen. Workers' compensation insurance protects employers from which of the following risks? And you can answer right there on your screen, A, B, C, or D. So as Mike mentioned, this is our third poll question. We'll have one more during our presentation as we kind of wind down some of the material we've been covering here. So you'll need to answer 3 of the 4 poll questions in order to qualify for CPE credit. We'll get those certificates out to everyone within the week. Everyone who qualifies will get a certificate with their CPE credit with it. If you have any questions for us, please use the question box in the webinar console. Submit those questions. We'll get to as many as we can. We have a little bit of time for Q&A at the end. So we'll get to your questions. We had some come in through the registration process. But if we don't get to your questions, we'll certainly follow up with you in the next day. And then look for an email later today. It'll have a link to download this presentation as a PDF, a link to watch or share the recording, video recording, and we'll also have our evaluation survey. So if you can just take a moment to complete that survey. It's just 5 quick questions about the presentation today. All right, do we have everybody? Yep, looks like we have everybody in. And the answer here is D, both A and C are benefits of workers' compensation. All right, and Mike, I'll turn it back to you.
Thanks, Trevor. All right, so let's take a look at some updates in the household employment industry. We'll start with Washington's statewide Domestic Workers Bill of Rights, which was signed into law in March. It establishes basic labor rights for household employees who work at least 4 hours per month. The new law takes effect on July 1st of 2027 and requires that domestic workers receive state minimum wage and overtime pay for any hours worked over 40 per week. Employers must provide clear contracts in a language the worker understands and cover the pay rates, hours, and terms. Employers must give advance written notice of termination, and if they fail to do so, then severance pay is required. Employers cannot confiscate personal documents. That includes passports, and they also can't monitor workers in private spaces, such as bathrooms or bedrooms, or restrict their private communications. Workers are protected from retaliation for exercising their rights or disclosing their immigration status, and they can file complaints with the state's Department of Labor and Industries. The One Big Beautiful Bill Act was introduced, and it introduced the no tax on overtime rule. While it doesn't change how you or your clients run payroll, it does directly affect an employee's federal income tax liability. Federal income tax will no longer apply to the overtime premium portion. which is that half in the time and a half of certain qualifying overtime wages. To benefit from this deduction, the overtime must meet the requirements of the Fair Labor Standards Act. For household employment, this applies only to live-out employees, and the employee works over 40 hours in a 7-day work week. If an employee is paid $20 an hour, their overtime rate is then $30 an hour. That extra $10 an hour is the overtime premium and is not subject to the federal income tax. And remember, live-in employees are not required to be paid overtime under the FLSA. The state laws we discussed earlier regarding live-in employees and daily overtime don't apply here. It's just what's federally mandated by the FLSA. Also, double time, holiday pay premiums, or guaranteed overtime hours that are not directly tied to FLSA mandated hours don't apply. While your client still must pay these amounts based on state law or their employment agreement, the employee cannot claim the federal tax deduction on those premium payments. So the employee can deduct up to $12,500 for individuals or $25,000 for joint filers. The deduction will be claimed when the employee files their personal tax return. This deduction does not impact Social Security, Medicare, or state income taxes. Those contributions all remain exactly the same. This past tax season, the IRS provided penalty relief to employers for no tax on overtime due to failure to file correct information returns or to provide correct payee statements to the employees. That means employers did not face penalties for failing to separately provide the total amount of qualified overtime compensation. The relief is limited to returns and statements filed and provided for the tax year of 2025. For 2026, however, the W-2 form has been updated to accommodate the federal deduction for qualified overtime compensation. Employers can use Box 12 with code TT for qualified overtime compensation. This requirement also means that accurate timekeeping for household employers is even more critical. Hours worked should be tracked weekly so overtime can be calculated correctly. This will make it easier at year-end to provide qualified overtime compensation on the employee's W-2. So the tax reporting rule for mobile payments has been phased in and has reached the statutory level. Employees will receive 1099-K forms the next tax season if this year's reporting criteria of $600 in transactions are met. The reporting rule may change how your clients pay their nannies and babysitters. Payments for goods and services, such as babysitting or childcare, made through third-party settlement organizations, such as Venmo, PayPal, and Cash App, will be reported to the IRS if the transactions totaled $600 or more. The intent of the requirement is to target businesses that use these apps to circumvent banks and traditional income reporting. The IRS wants to make more transactions reportable, so it's harder for businesses to underreport their taxable income. Unfortunately, with all of this, household employees are getting swept up in there. Families that don't employ full or part-time household help, such as nannies, in-home senior caregivers, and may want to avoid using mobile payment platforms to pay their workers. Those workers will likely receive a 1099-K from the IRS and a W-2 from their family, which can cause a lot of confusion. Paying for a date night or occasional babysitter through a mobile app may still be acceptable, but those sitters should know that this income will likely be reported to the IRS and should be reported on their personal tax return. It's always been a requirement to report income when net earnings from self-employment exceed $400. This new rule just broadens the reporting of tax information to the IRS. A seemingly easy way to circumvent the new rules may be to pay a babysitter through a personal transaction as if they were a family member or a friend. However, if you pay a babysitter regularly, those consistent transactions will raise red flags with the payment platform and call into question whether the payments were actually made to a family member or a friend. In fact, PayPal, which also owns Venmo, says it will monitor accounts to ensure it's always best practice to pay a babysitter as a service transaction, and a best practice is to pay a full-time nanny or employee via direct deposit or by check. So here are the contribution limits for certain employee benefits for the 2026 tax year. Contributions are made on a pre-tax basis, which can reduce the amount your client and their employee owe in taxes. Plus, offering benefits is a great way for your client to retain top workers and attract the best candidates. Here are some of the key contribution limits relevant to household employment. So I just want to highlight the QSEHRA, which stands for the Qualified Small Employer Health Reimbursement Account. This can help an employee reduce their healthcare costs tax-free. This is for employers with fewer than 50 employees as long as they don't already offer a group health insurance plan. So this is perfect for families with household help. Employees are reimbursed for health insurance coverage purchased on the individual market or through the healthcare exchange, and for out-of-pocket medical, dental, and vision expenses. These plans are funded by the employer, and these contributions are not taxed for the employer or the employee. Reimbursements are also not taxed as long as the employee has a health plan that meets minimum essential coverage. A dependent care FSA, sometimes referred to as the Dependent Care Assistance Plan or DCAP, is a pre-tax benefit account that's offered by employers and used to pay for qualified, out-of-pocket dependent care expenses, such as a nanny's wages. By contributing to a dependent care FSA, your client will reduce their overall tax obligation because funds are withdrawn from their pay and placed into their account before taxes are deducted. It lowers their taxable income, both for income and FICA taxes, so your client ends up paying less in taxes overall. For 2026, the maximum annual contribution for a dependent care FSA will increase to $7,500 per household, or $3,750 for those married filing separately. This change was all part of the One Big Beautiful Bill Act, which provides a permanent but not inflation indexed increase to the contribution limit for the first time since 1986. As we've discussed, household employees must be paid the highest applicable minimum wage among federal, state, and local rates. State and local rates have been rising. Many states and cities are making incremental annual increases until they reach about $15 an hour or more. So this is just a sampling of states and other jurisdictions that are popular for household employment and have increased their minimum wage rates on July 1st. Virginia recently enacted the paid family and medical leave and paid sick leave programs, significantly expanding worker protections. The PFML program allows eligible workers to take up to 12 weeks of job-protected leave per year, with benefits that replace up to 80% of their average weekly wage. Payroll contributions for employers and employees begin April 1st, 2028. However, employers with 10 or fewer workers, which likely covers household employers, only need to remit the employee portion. Benefits will become available, and claims can be filed starting December 1st, 2028. Qualifying reasons for leave will include birth, adoption, or foster placement of a child, the employee's own serious health condition, caring for a family member with a serious condition, military family needs, or safety-related services regarding domestic violence. Virginia's paid leave law mandates that employers provide 1 hour of paid sick leave for every 30 hours worked, up to 40 hours per year. Effective July 1st, 2027, the rollout will be phased in based on employer size. For employers with between 1 and 24 employees, the effective date for this is January 1st, 2029. Beyond standard medical needs for the employee or employee's family member, the law allows victims of domestic abuse, sexual assault, or stalking to use paid sick leave to relocate, obtain medical care or counseling, seek legal advice, or utilize other victim aid services. Notably, this safe leave can also be used if the employee's family member is a victim. The law also defines family member broadly, and this includes any other individual related by blood or affinity whose close association with an employee is equivalent of a family relationship. Retirement plan requirements are starting to take hold across the country as well. Most state laws likely won't apply to household employers because of the minimum number of employees required to qualify. However, California has now lowered the threshold for its retirement plan requirement to just 1 employee, down from 5. So, your clients in California must enroll in CalSavers or sponsor a qualified retirement plan on their own and report that to the state. Maryland's law is new and starts with just one employee. However, your client must have been a household employer for at least 2 calendar years to qualify. Again, clients can enroll in the state program or they can choose to sponsor a retirement plan of their own instead. Looking ahead, Hawaii will require all employers to offer a retirement plan by the end of this year, and Washington State is scheduled to launch its program in 2027. So I'd like to wrap up with some of the benefits of being compliant. We've already talked about the first 3 benefits on this list. It lowers your risk and helps you avoid trouble with the IRS, workers' compensation boards, and disgruntled employees. A client can also take advantage of those tax breaks, which may be more than their nanny tax obligation. For an employee, they'll have a legal employment record and verifiable income, which in turn helps them with getting a loan, mortgage, or line of credit. If a nanny wants to buy a home or a car, it's better that they're paid legally. They can also get unemployment benefits if they are let go through no fault of their own. They're also protected by workers' compensation if they're injured on the job. And in states with disability insurance requirements, they're protected for injuries outside of work. With senior care, you can look to reduce costs through long-term care insurance and veterans benefits. To take advantage, you may need to provide payroll information and caregiver activity logs, so the caregiver does need to be paid legally for this. Your client may be able to deduct expenses they paid during the year for medical and dental care for themselves, their spouses, and their dependents. And IRS Publication 502 has more details on that. With a medical care or healthcare FSA offered through your client's employer, they may be able to pay their elderly loved one's medical expenses that aren't covered by insurance. The senior must qualify as their dependent for this. If the person receiving care lives with your client, is physically and mentally unable to care for themselves, and requires a caregiver to care for them so that your client can work, then your client may be able to pay some of their senior's care expenses with a dependent care FSA that's offered through their employer. The senior may also be a qualifying individual under the Child and Dependent Care Tax Credit. The senior must be physically or mentally incapable of self-care, have lived with your client for more than half of the year, and be either their dependent or could have been their dependent under certain exceptions. These are potential options for your client to reduce their tax obligation and reduce their costs as a household employer. And I will turn it to you, Trevor, for our final poll question.
All right, thank you, Mike. The last poll question is on everyone's screen now. What are the benefits of being compliant with domestic payroll laws and regulations? So this is our final poll question. We've presented 4 during the presentation today. If you've answered 3 of them, you've qualified for CPE credit, and those certificates will be emailed out to everyone within the week. You should be able to receive that. We're just winding down our formal presentation, and we're going to get to your questions. We had a couple come in through the registration process, and we have a couple others to get to. So we'll be sure to get to as many as we can in the time we have with you today. If we don't get to your question, we'll be sure to follow up with you in the next day and get you some answers. We've covered a lot of good stuff today. And if you do have a question, just use the question box in the webinar console. Submit your question there. And again, we'll try to get to it today. If not, we'll follow up with you. You'll also get an email by the end of the day with a link to download this presentation as a PDF, a link to view a video recording of this. You can also share these with colleagues as well. And then we also have a quick evaluation survey. It'll pop up as you leave the webinar today, and it'll also be in your email. It's just 5 quick questions. We'd appreciate your feedback on the presentation. So with all of that said, it looks like everybody is in, and the answer here is D, all of the above. All of those are benefits of compliance. All right. And Mike, I'm turning it back to you.
All right. So if you have a client with household employees, these are your steps that you or they need to take to be compliant. So they must file federal and state unemployment taxes every quarter and prepare W-2s, W-3s, and a Schedule H at the end of the year. The last point here could be the most important. Tax, wage, and labor laws are constantly changing. We talked about paid leave laws, minimum wage rates, and domestic workers protections, and more are coming. So it's important to monitor changes in the law that may affect your clients who employ household help. Don't procrastinate. We can't emphasize this part enough. Household employment compliance is not something you'll want to handle at tax time. You have enough going on, and you don't need a client to tell you in January that they hired a nanny for the previous year and haven't been withholding taxes. You'll then need to track down hours and wage information to make sure that minimum wage and overtime rules have been followed. And that's the last thing that you'll want to be doing during your busy time of the year. It's much better to get on top of this at the time of hire. Also, keep in mind that workers' compensation needs to be in place before the employee even starts working. And again, those fines are daily, so it's important to get them set up beforehand. So on your screen here is a list of resources available, including publication 926, which is essentially the IRS Bible regarding household employment. We discussed using the Form SS8 if you want the IRS to tell your client that their nanny is an employee and not an independent contractor. And the W-4 form is needed if your client plans to withhold income taxes from their employee's pay. So I'd like to thank you all today for attending our presentation, and I do hope that you found it valuable. We may have some time for a few questions now, but if anything comes up while you're handling nanny taxes or household payroll, please don't hesitate to contact us. We're more than happy to help. And on to the questions, Trevor. What do we have?
All right, Mike, thank you. The first question we have, are there any specific rules for California when employing household staff?
Yes, so California, we do have many rules for them, and some of them that we did cover in this presentation. California has daily overtime, paid leave laws, sleep time laws, domestic worker protections, and many cities in California now have their own minimum wage rates. We could probably host an entire presentation just on California household compliance.
Mhm.
I would highly suggest visiting our website. And in the Resource Center, we do have a state by state compliance guide that will detail all specific labor laws for all 50 states. And we're also here to help with any specific questions. California gets complicated when it comes to household employment compliance, so we're happy to walk through any questions or issues.
That's right. Mike's email address and phone number on the screen. So any questions about California or any other state or just household employment in general, you can reach out to him. But and also our website, gtm.com/household. As Mike said, Resource Center, and there's some state guides there to help you out. Our next question, what about employees who do not have social security numbers or need to update their ITINs?
Sure. So, an employee that has an individual taxpayer identification number or the ITIN and not a social security number, it can get you in a little bit of hot water. The ITIN is a tax processing number issued by the IRS to someone who's required to have a taxpayer identification number, but doesn't have or is not eligible to have a social security. These don't serve any purpose other than federal tax reporting. So let's say like a non-resident alien who is a college student or researcher. They may receive taxable payments such as fellowships, scholarships, or awards, and they do need to be able to report those to the IRS even if they can't obtain a social security number. The ITIN, though, it doesn't authorize work in the US or cover any kind of legal presence or immigration status. So when January comes and you're filing the W-2 with the Social Security Administration, you may receive notices and fines for filing W-2s that don't have a Social Security number on it. If your employee is authorized to work in the US, they should obtain a Social Security number as soon as possible. And you can even apply for this online now. And then make sure, of course, to use that Social Security number on all tax documents going forward.
All right, Mike, we have time for one more question here. Can a parent taxpayer take a medical expense deduction for payments to an adult child who cares for the parent in their home?
So the short answer to this is yes. Parent taxpayer, they can take medical expenses, deductions for payments made to an adult child. Certain conditions do have to be met with this, though. The payments must be for qualifying medical expenses under IRS rules. That'll generally include services that assist with daily living activities. So anything with bathing, dressing, feeding, medication management, or nursing care. General household chores and companionship services won't qualify for that. And the medical expenses are deductible only if the parent itemizes deductions on a Schedule A, which is the Form 1040, instead of taking a standard deduction. The deduction is also available for unreimbursed medical expenses exceeding 7.5% of the taxpayer's adjusted gross income. And the adult child must report the income on their own tax return. Formal caregiver agreement should also be in place to kind of help establish that payments were legitimate expenses and not gifts, of course. However, if the adult child is providing caregiving as an employee, then the parent could be considered a household employer and should be withholding taxes, providing a W-2, amongst the other responsibilities that we discussed. And you can do one or the other. You can do household employer or medical expense deduction. The household employer approach may be best if the caregiving relationship is more structured, ongoing, or involves significant non medical tasks. The medical expense deduction approach is better if the child provides services that strictly qualify as medical expenses.
All right, Mike, we are at the end of our time with everyone today, so we appreciate everyone who is able to join us today and stuck with us through the presentation. We appreciate your time, and if you answered those poll questions, you'll receive your certificate the next few days. If anything comes up after we're done here today, feel free to reach out to Mike. His phone number and email address are on the screen. You'll also receive this presentation as a PDF, so you'll have that and a video recording, so you can look for that email later today. So, and also we'll have an evaluation survey in that email. It'll also pop up as you exit the webinar today, so please complete that. It'll help us out going forward. And again, if we can be of any assistance to you or your clients, please don't hesitate to reach out. We'll be more than happy to help. So once again, thanks for joining us today and have a great rest of the day.